Investments. Of course you get a bonus section for investments. Today we understand that a stock makes us a part owner in a business. But how do you start to pick them? How do you choose which one? And is there a way to choose them all? Six point four. I want to introduce you to mutual funds and this idea called an index fund. Yesterday we learned what a bond and a stock is. Now you're understanding the idea of being a lender and a partner. But now your question still remains. How do I purchase them? How do I buy them? How do I build out an investment portfolio? Well, the portfolio will be level 2 and 3. Today, we want to talk about an opportunity and option for you to perhaps solve all your questions with a single purchase.
Hold up. Wait a minute.
Before we get into all that, let's go check in with John and Charles and how they're looking at expanding and diversifying. Looking at the map of Stitchville, John and Charles begin to weigh and measure how they're going to expand their lemonade stand empires. John looks at the map and says he likes the stands on 2nd and 4th Street. Why? Well, there's a soccer field on 2nd and a playground on 4th. So he thinks that the lemonade stands there are going to get more profit and value. He actually finds a company called Mutual Fund Lemonade that owns parts of those stands on 2nd and 4th and decides to invest with them. Charles, on the other hand, he looks at Stitchville and says, I think the lemonade stand industry is going to go up. But he doesn't see any advantage for which street. I mean, how can you decide where kids go after they're done playing or after a game? So he looks at all the streets, 2nd, 4th, 1st, 3rd, Main, all of them, and wonders, is there a way he can own a share of all of the lemonade stands? It just so happens he finds a company called the Sweet and Sour Index. They own a small share of lemonade stands on every street in town. So he decides to invest with them. So John wants to diversify, but he thinks he can predict where there's money to be made and goes and buys that mutual fund. What we're going to see is that a mutual fund is a grouping of investors that go and purchase a group of stocks or bonds, and it's directed by an investment manager. They believe they can see where money is going to be made. Charles also wants to diversify, but as he looks at the town, he doesn't think he can predict which stand is going to improve in profit. So he wants a share of all of them. That's why he buys an index fund. An index is just a measurement or a tracking tool of a sector of the market. Let's take the Russell 3000. That is an index of 3,000 companies, and it measures how all of those companies are rising and falling. On the other hand, if you buy an index fund, that allows you to take that same measurement and purchase shares in all of them. Look at the lemonade stands. He bought a small percentage share in every lemonade stand in Stitchville. Now, when you look at mutual funds to indexes, index funds are mutual funds. They're just much, much bigger. Index funds are much bigger versions. Mutual funds, got it. But there are also two other differences I want to share. Around price point, mutual funds are actually going to be more expensive because you're now paying a manager to pick which companies to put within the mutual fund. The index fund, on the other hand, doesn't need a manager. They simply purchase every company on that index. The other difference is going to be around your risk profile. If we look at this risk management arrow, you will begin to see, starting with the most risky. If you just simply went out and bought a single stock, maybe let's call it company X, that would be the highest risk profile. You have the highest return, but also the highest risk. If you look to diversify and get into the mutual fund, now you're not just buying company X, you're buying company W, X, Y, and Z. That diversifies you, but remember, you got to pay a manager to choose those companies. Then you take that next step to the index fund, and why I think this is such a neat tool for you. The price goes down, no more manager, and you're not buying W, X, Y, and Z, you're now buying the whole alphabet. So let's say a mutual fund is probably a tech mutual fund, has a bunch of companies like that. An index would be the S&P 500 or 500 of the largest companies in America. That is how we're going to begin to invest. Sneak peek to chapter 10 will tell you specifically how to go start investing. Now we see index funds gives us investing's free lunch. 6.2's diversification lesson, we look at how it will reduce your short-term risk while not taking away your long-term returns. That's why it's a free lunch. The question of the day, what's the difference between a mutual fund and an index fund? The action item today, go ahead and Google what are the top 25 index or mutual funds in the world. See how with one choice you can own hundreds or even thousands of companies. Come back tomorrow because we're going to decide and understand what happens if your vehicle gets in an accident.